Okay, so this is the first challenge problem from chapter 10, and I want to reiterate that I don't need you to fill in this whole area over here on Pearson. It's just a lot of tedious data entry. What I will require and want you to do is to do the Excel model, because as you'll see, as we develop this thing, it will be quite useful. This happens to be the blank that I provided for you from chapter 10, homework 2, and we're just going to keep adapting this for these challenge problems as the specifics change a bit. But this is kind of how these financial models grow and develop, is you start with something simple and then you develop it into something more complex until you get to the point where you have a functional portfolio as a finance professional of flexible models that can be adapted to specifics of what you need them for. So here we have a medical device manufacturer who is looking at bringing another device to market. They're going to use their old manufacturing equipment, and if we bring this device to market, we're going to basically replace the a different product that provides 1.75 million in 1.725 million in erosion costs, I guess, or opportunity costs. So let's go ahead and add that in. So let's go ahead and pick up all these costs numbers from the pop-up window here. So we have an equipment cost of $23,650, and the design and prototypes we can just add a new line for. And we are going to sell the thing for $24.70. And let's see, first year sales forecast is going to be $16,720. And let's see, they're growing the sales by 6.5%. So we'll insert another line and say we'll sales growth rate is 6.5%. And let's see, our cost of goods sold is 42% of sales, and our selling and administrative and general, so those are our variable costs, are going to be 47% total. So let's make that a percentage. And then the fixed cost is $596. And let's see, our erosion cost here. The economic life of the project is 5 years. Initial change in net working capital is $495,000. And depreciation at 5 years makers, the tax rate was 34%. And the cost of capital was 8.5%. Okay, so now we have all our inputs. And what we need to do now is we need to think about modeling our cash flows. And one thing to keep in mind is this issue of erosion costs here. This is not something that we've looked at in these large-scale problems before, but it is something that's important. We have to somehow take into account the fact that you're going to have basically an opportunity cost of $1.7 million for this revenue stream that you gave up if you create this new revenue stream or cash flow stream. And so what you should do with this is add another line down here in your operating cash flow calculations. And you could title it, we'll say, less erosion cost. Okay, because we need to remember that before we can actually give the operating cash flow, we need to consider the fact that we're losing some money as well, right? So now we're ready to go ahead with our calculations in our model. Okay, so the first thing, we've got to pick up our revenue from above. Okay, so there's that. And then for year 2, our revenue is going to be 6.5% more than that. So let's take this revenue number and then grow it. And the way that you grow any number by a growth rate is you multiply it by 1 plus that growth rate. And if we make that column B an absolute cell reference, then we can just autofill that. So let's leave that there. And then our variable costs are going to be 40% of revenue. And again, if we make that 47% figure absolute, that will be able to be autofilled. Fixed costs are going to be this 596,000 absolute. And depreciation is going to be this maker's percentage for the year times the equipment cost, which we can make absolute. That then gives us our earnings before interest and taxes, which is the revenue minus all these costs. And then we'll tax that. That's 34% absolute times EBIT. And that'll give us our net income, which is EBIT less taxes. And then, now that we have our net income, we have to add back the depreciation to start working towards our cash flow. So take the income and add depreciation. That gives us our pre-erosion operating cash flow. Okay, I'm pretty confident with that, so let's go ahead and pull all of these rows out. Oh, this obviously was not an absolute cell reference here, so we'll fix that. The rest of them are kind of making sense. Oh, they're making sense because the net income went down quite a lot in the second year, but that was because depreciation was so very high, because 32% of your value was getting depreciated. But even so, of course, we still have a higher operating cash flow. So these all seem to be working okay, and so we'll just take and autofill these out to the rest of the years, and these are your operating cash flows for the 5 years of this project. Okay. Now, next challenge. We got to figure out our terminal cash flow due to the sale of the equipment. So if you remember, the way that you calculate that is you look at the book value, which is the purchase price minus the sum of all the depreciation. Right, so let's get that one figured out. So our equipment cost was $23,650, and we are going to add up all of our depreciation expenses here. There we go. 1.419 million. We're going to sell it for 2.47 million. Right, and so what we have to do is figure out whether that's a gain or a loss, and I can see that the selling price is greater than the book value. Right, so we're going to have to go ahead and multiply the gain, which is 2.4 minus 1.4. So let's figure that one out. Times the tax rate. So that's going to be the tax on the gain. And then our after-tax cash flow is going to be the selling price minus the tax on the gain. Now I should note that there is an error in Pearson. Pearson is telling you that you should be calculating the after-tax cash flow as the gain minus the tax on the gain, and that's just wrong. That's just an error, and I need to get in touch with the publisher and tell them that that's an error. The after-tax cash flow here is going to be that 2.47 minus the tax. So that's our after-tax cash flow is 2.112 million. So now we're ready to go. Now we can go ahead and complete this table here. So our initial cash flow at the beginning time is going to be the negative of the equipment cost, and the change in net working capital down here, 495, is also going to be negative. That means you have to buy more, inventory and whatnot. Okay, and let's go ahead and while we're thinking about working capital, because I don't know about you, but I always forget to do this at the end of these analyses. Let's go ahead and pick that up as a positive cash flow in year 5. Okay, our operating cash flow is just going to be picking up that value there. Okay, and then our cash flow from salvage is going to be happening out in the last year, in year 5. That's the 212. So our incremental cash flow, therefore, is going to be sum of this whole column here. Let's see how we do. Okay, so this is the correct answer, but it's not going to give you the right values in Pearson, right? Because Pearson has an error. Okay, so what I'm going to do here now is I'm going to change this so that it matches what they're doing with Pearson, because I'm not as interested in the actual technical answer as I am in doing all these sensitivity analyses that they want you to do. Okay, so I'm going to go ahead and recalculate the after-tax cash flow here to be in alignment with the way that Pearson wants you to do this, which is, let's see, it's the gain minus the taxes is the way that they wanted you to do it. So it is the gain, which is the selling price minus the book value, minus the taxes. Okay, so remember, this number is wrong, but it'll allow you to go through the process with Pearson and check my work if you wanted to do that. So to calculate the net present value using Excel, remember that the NPV function in Excel isn't technically correct as a net present value. What you have to do is take the present value of all the future cash flows and then subtract your initial cash flows. Okay, so let's go ahead and do that. So you say NPV, and you are prompted to give the discount rate, and then the values of the future cash flows. And then you want to subtract the initial investment, which in this case means we're adding that value here because it's already indicated as a negative. Okay, so our net present value is $423,000. So yes, we should go ahead, since the net present value is greater than 0, then accept the project. But then they go on and they say, well, let's see what happens if we are growing sales at 13% a year. So let's go ahead up here, and it should work. It should work if we just take and change the growth rate to 13% a year. If you watch down here, it should just automatically recalculate. So let's see how that looks. Okay, so at 13%, we've got a $3.7 million net present value. And then what happens if it's only a 1% growth rate? At a 1% growth rate, it gives us a negative $2 million net present value. And so what I'm going to do, I'm going to show you a little trick. Okay, so I want to record these values of the net present value when we change the rate of growth of sales. Right, so here's how you would do that. Now there's a couple of different ways you can do it, but let's just do it with the most basic way. So let's make a little table of NPV at various growth rates. Okay, so I'll make a little output table down here. I like to make things look nice. It makes it so much easier to figure out what you're doing, because you're going to come back to this in another year. You'll have no idea what it is if you don't make yourself some serious sort of obvious ways of finding your way around. Right, so we want the growth rate at, let's see, 6.5%. So we'll say base case, and best case, and worst case. Okay, and our growth rate is going to be 6.5% here in the base case, and the best case is 13%, and in the worst case is 1%. Okay. So our base case net present value, we're going to take this number here, we're going to copy it, and then we're going to paste it down here. But we're not going to paste the calculation. What we're going to do is paste the number. And the way that you do that is you say paste values and number formatting, we'll say. Right. So what that'll give us, right, if we just look at this number here, it's a number, it's not a calculation. So that means as I switch this number, this sales growth rate to 13%, everything recalculates, including this number down here, including this net present value. But this calculated value that we entered in as a value doesn't change, right? So this is kind of handy if you want to create this kind of a table. So let's go ahead and do that again. We're going to hit copy, and then we're going to hit paste special, value and formatting. There it is, 3.7 million. And again, now we can go ahead and change our growth rate to 1%. The whole thing recalculates. We can go ahead and, again, copy our result and paste it in as a value. Paste special value. And it'll give us our negative 2 million. And so what this tells us is that at a 6.5% growth rate, yeah, we show a positive net present value. But if the sales are flat or only growing a little bit, it shows a negative net present value. And so for me, as a manager, right, as an analyst at heart, right, that makes me a little nervous. Because we're replacing this product that has flat sales. Why would you think that this new product would not have flat sales? I'd want to have a serious talk with the marketing department if that were the case. And then the other question that I'm curious about, what's the growth rate in sales needed to have a non-zero net present value, right? This is kind of like break even. It's like break even except taking into account time. This is break even over time. And so what you can do with that, right, you can use this goal seek in Excel to give you the answer to that, right? So let's go ahead and do that. So you go data, what if analysis, goal seek. And we want to set this cell, our calculated net present value, equal to a penny, 0.01, by changing the rate of growth of sales. So what is the rate of growth of sales that we need to not lose money on this deal? Let's go ahead and hit OK. And it calculates. So we need 5.6% growth. Right, so as I said, you know, as a manager, as a finance person, as a skeptic, as an analyst, I'd want to get a very, very compelling argument from marketing that they can grow sales at 5.6% for a new product that's going to replace an old product that's flat. Okay, so that's the value of this kind of analysis right here. So that's how you do this. Again, this is all based on an incorrect an incorrect after-tax cash flow from the disposal, right? If we do it correctly, these numbers will change. And I'm not going to go through the whole process of doing copy and paste special here, but let's go ahead and redo this goal seek using the right answer for our after-tax cash flow. So let's see. Okay, so now we have the correct answer, which is 2.1 million is going to be our after-tax cash flow. Okay, and so now, right, our net present value at 5.61% is actually almost $1 million, right? So let's see what the answer is, what our net present value is, using the correct value for our after-tax cash flow from disposal. What's our sort of break-even, long-term break-even growth rate that's required then? Okay, so again, we're going to set the goal seek. So we're going to go goal seek. We want to set this value to a penny by changing the growth rate. Hit OK there. Okay, and now this is really cool. If we use the correct after-tax cash flow from disposal, we only need 3.5% growth in sales. A big difference. A big difference. And this is where finance and financial analysis becomes an important part of strategic management decisions. It's a big difference whether you have to grow sales at 3.5% versus 5.5% to even break even. Okay, that's why finance people get paid the big bucks, right? Because it's not trivial analysis. It's certainly something that's a pretty specialized skill set, which you guys now know. And yeah, so that's how you do the first challenge problem and actually bring it up a notch from what the book is asking.